Good afternoon, ladies and gentlemen. I'd like to welcome you to Outlook for Multifamily Sector over the next 12 to 18 months against the backdrop of COVID-19. We will review the impact of COVID-19. We're going to focus on workforce housing, multifamily, and senior living throughout the U.S. We have a great group of panelists. They're going to cover how we're thinking about rent collection, sanitation, and future opportunities on the horizon. We'll also talk about the impact of lower interest expenses while providing insight into their relationships with their lenders. And I would like to also just take a moment to thank Mike, his team at Flyer, and the sponsors for putting this together. So as Michael mentioned, my name is Nick Neri. I am the Vice President of Circle Partners. We're a global fund administrator. I have the distinct privilege of moderating today's panel discussion. I've been in the financial service industry for about 25 years with an emphasis on traditional alternative investments. Born and raised in New York, came on board with Circle Partners in 2016 after I sold my ownership to a publicly traded admin. Circle Partners, very quick overview, and then we'll jump right into the panelists. Was created in the year of 2000. We have 10 offices in 8 different countries, about 140 employees. We focus on open, closed-ended funds, any type of strategy and structure, supporting, AML, KYC, cash management, tax and audit prep. And without further ado, let me do this. Let me pass it over to the most important folks today, the panelists, which I'd like to introduce Ernest Johnson. Ernest, let me kick it over to you so that you could give a quick bio. He's from ApexOne Investment Partners.
Great. Thanks, Nick. It's a pleasure to be here. Anytime I can share a panel with Nate, Grant, Lloyd, now I'm in good company. ApexOne Investment Partners is a nationwide sponsor of workforce housing, founded in 2012. We're on our 3rd fund right now, and we'll be announcing our 4th fund shortly. We're proud to be one of 65 select sponsors designated by Freddie Mac, which means we have significant access to capital at reduced prices. We've also obtained Mercer's highest rating of retain from Mercer Consulting. We've acquired over 15,000 workforce and student housing units during that period of time, investing about $350 million of equity in 43 assets, which equates to about $1.2 billion of multifamily assets over that period of time. We are unusual in the sense we make monthly distributions to our investors. We've achieved fantastic returns on our investments over the last 12 full cycle properties that we've had realized gains on, averaging about 28.5%. Our senior management has about 150 years of experience. We've been through all 5 of the most recent economic recessions, so we're playing from a pretty strong standpoint for what we're facing right now. And as I mentioned, our special situation fund focusing on the ability to capitalize on opportunities coming into this market will be opening in July of this year. So thanks very much, Nick. Look forward to working with this panel.
Thank you very much. Appreciate it. Nate Klein, One Wall Partners.
Nate, can you unmute yourself?
Yep, I just got the notification to do that. Hi, everyone. Nate Klein, Chief Investment Officer at One Wall Partners. We are a vertically integrated owner-operator of workforce housing in the Northeast of the U.S. Been around for a number of years, work with 2 other partners. We've acquired about 4,000 apartments, valued of in excess of $600 million. And we focus primarily on major employment centers where there's diverse employment and lots of education, medicine, and government workforce. We've been able to weather the current economic environment pretty well and have come up with a preferred income fund strategy that is further resistant to this type of economic environment by having seniority in the capital structure and access to immediate and ongoing quarterly distributions from the assets. Fundamentally, the Northeast region has a dramatic supply-demand imbalance, and that's the fundamental tenet in our strategy that allows us to look ahead and see a very long-term positive horizon for our business.
Thank you, Nate. I appreciate that. Grant Cardone from Cardone Capital. Grant, please go ahead.
Yeah, my name is Grant Cardone, CEO of Cardone Capital. We have 8 funds available before managing a family portfolio of 7,722 units worth about $1.8 billion. All our funds were crowdfunded using Instagram and Facebook. We raised $360 million in the last 25 months, mostly A- and B+ properties throughout the Southeast. Large garden style apartment complexes, average 360 units. And we are beneficiaries of the coronavirus. I mean, frankly, we're sitting on 93% occupied and almost 97.5% collected in an epidemic. So it's a great place to be with multifamily right now.
Thank you, Grant. Appreciate it. Chris Finley. Chris from Lloyd Jones. Chris, are you there?
Chris, please unmute yourself. There you go.
All right. Hey, Chris Finley here with Lloyd Jones, and we're a multifamily senior living investment development and management company, about 6,000 units. We focus on the Southeast and are expanding into the Southwest.
All right, thank you very much. I appreciate that. Thank you so much for the intros. Obviously, we have a tremendous panel, a ton of experience. So let's jump right into some questions. So first question, and I'll propose it to Ernest, then we'll go to Nate, Grant, and Chris. Over the past 2 months, obviously we've faced COVID-19. We've obviously faced a tremendous amount of challenges. And where do you see right now rental payments tracking? You know, are payments still flowing in? Or has there been an increase in late payments? Maybe you could both talk about that from a multifamily housing perspective. And also, you know, what market areas are you seeing this type of adjustment in? Maybe you could elaborate a little bit on that, Ernest. Thank you.
Sure, be glad to. Well, I think the first thing we're realizing is our residents take their credit history and credit rating very seriously. Again, you go back to Maslow's hierarchy of needs. Food and shelter is the basic foundation for any individual or family, and they're protecting those along with securing their healthcare packages as well. So we know residents want to protect this credit history. As Grant mentioned, our collections in April were 98.7%. We're right at about that same amount for May. Not quite there because we have allowed some of our residents to pay, you know, twice or 4 times a month to provide them with assistance. So we're seeing the collections continuing to be high. You know, again, we realize the residents, if they're not living here, they're going to need to live somewhere else. We think a number of our residents really don't live, you know, paycheck to paycheck. They've had some reserves. They may be dipping into those reserves that maybe they were setting aside for housing. We're also surprisingly seeing our occupancy increase. We not only have new residents coming in, but we're seeing a reduction in the notices to terminate leases. And again, I think that's because it costs money to relocate. And during times of uncertainty, sometimes just staying where you are is a good strategy. So that's what we're seeing in our sector.
Terrific. Nate, would you like to jump in, please?
Sure. Yeah, I would echo a lot of the same things that Ernest mentioned. You know, we too are seeing good collections. Occupancy today is, you know, roughly 96%, which is the same as it was last year at this time. Turnover appears to be going down, you know, again, for the reasons that he mentioned, as well as, you know, the fact that, you know, we're operating in a market where, you know, affordability is that much more important than it even was, you know, before this environment. And generally speaking, our residents have been, you know, well vetted by us in the first place as people that can support their monthly rent, and we think that, the longer this sort of economic dislocation goes on for, the more likely that we'll actually even see some trade down benefits from some of the higher priced real estate in, the environments that we operate in. We're very close to, urban markets with very high priced real estate relative to the basis that we offer and the rents that we offer. So we're in a good point for that benefit to occur. And the collections at this point, this month, are on par or in some cases even better than they were last month.
Thank you, Nate. Grant, would you like to give your perspective? Obviously, having over 7,700 units, what are you seeing in the market?
Well, one thing on our end is we by using crowdfunding, we bypass using JP Morgan or Morgan Stanley or any of the big institutions to dictate what we do at a time like this. I'm a preferred borrower with Fannie, Freddie, and the life companies as the primary debt, but our equity comes from both high net worth and Reg A investors that either do business with me and other companies or possibly read my books or somewhere became a customer. So that being said, the equity portion of this probably $700 million worth of equity, I don't have an institution grinding me out every day about collections. And then therefore I can spend my energy and efforts working with the tenants, talking to tenants about how can we help you? What can we help you with? How can we make you a deal so that you secure your future? Back to the comment about, I need a place to live, period. I mean, multifamily is beating out every sector in the marketplace right now because people need a place to live. They're not going to give the keys away to their apartment. They know their history follows them. They're more likely to give away the keys to their car and ride share in the future, I believe, possibly even officing at home. I think the remote officing can actually benefit. We saw renewals last month higher by 2x of any renewal term I've ever had in 30 years. So people want a nice place to live. If it's nice, good location, if they haven't lost their job, some of these people are living paycheck to paycheck, but this isn't the part of the paycheck that they're willing not to spend money on.
Grant, is there any creative scenarios that you guys have come up with? I know you had briefly mentioned you'd try and come up with solutions for them if need be. Has there been anything that that resonates that maybe you want to share?
So because my first career was not in real estate, this was a side hustle for me. So I've worked with retailers around the world, most of which, like JCPenney's and Sears, wouldn't listen to me. But I have consulted with Fortune 500 companies for 30 years now, talking about strategies to provide better customer service. And one thing that we implemented that I learned from auto dealers years ago was how to reach into the future, offer a tenant, a resident, 15 months. We did this in April, 15 months of rent for the price of 12 months, but they had to put it on a credit card in order to do so, which reduced their outlay by almost half. So they would pay Visa now, not Cardone Capital or the property level. This provided them with a better cash flow position and insured us of about 4% of 7,000 units secured 15 months into the future where they would live. That was extremely successful, along with some other programs, just simply communicating with the residents saying, hey, we care, we're here for you, we want to take care of you. People don't want to leave, okay? And all the forbearance noise, if the media would just stay out of the confusing people, like our tenants are not asking for forgiveness of rent. They know that if they don't pay, the next place they live at will not be as nice as the place they live at now. And most people don't want to go down. They want to go up.
Thank you. I appreciate that. Chris, let's just reiterate and focus back on the rental payments and where those are kind of tracking. You know, are the payments flowing in, or have you seen an increase in late payments, or is everything on time from your perspective? Maybe you could share what's going on in your market.
Yeah, listen, I think we're performing just, similar to everybody else on the panel. And the only thing I would say that is critical right now is management. And, you really have to focus on giving your residents the attention, and communication is absolutely critical. So our on-site staffs have really worked hard and communicated with our folks, and we're there. And sometimes it's a matter of helping them apply for unemployment or helping them with other issues, but we're there, and being vertically integrated and having our own management team there is critical in times like this. I mean, this is where, management shines, and it makes the investment happen.
Thank you. So we had a question that came in, and I'm going to throw this out to Ernest. It says, what will be the impact of COVID-19 on your expected IRRs? Ernest, do you want to jump in?
Yeah, I actually think that's going to increase our IRRs. And again, IRRs we're looking at in terms of realized IRRs when we sell these properties. If you're looking at yields, we're certainly budgeting for lower yields. We're not pushing rent increases. We're doing as Grant mentioned. We're working with our residents to make sure that we aren't putting undue stress on them. But I think in the long term, IRRs are going to go up, because I think this pandemic is going to drive more people into the multifamily sector. They were going there before, and there's nothing that's happened to benefit them to lead them out of the multifamily sector. If they were planning on buying a house, they probably have less money to buy that house. They've had to use some of those monies to get through this tough time, or they've had a decline if they invest in the market. Credit is tighter to underwrite, so it's going to be difficult for them to buy a home if they can find a starter home. I mean, the starter home business was down before the pandemic. It didn't get any better during it. So I think that IRRs are actually going to go up over the next few years as investors continue to flock and see the strong fundamentals in the multifamily sector.
Couldn't agree more.
Thank you. So is there an increase in supply and demand right now? And what do you think from a COVID perspective? What have we learned, long term on how to handle these situations? And I'll throw that over to Nate.
Yeah, I mean, well, there's certainly not going to be an increase in supply of workforce housing. If anything, all of the juice and stimulus that's gone into the economy is going to likely cause even greater inflation in construction than we've had historically. So that's one thing that we're keeping an eye on, and if that's the case, then the spread between the basis that you can buy existing assets versus what you can build for is only going to expand, and the demand side of the curve isn't going anywhere either. With we think again part of the reaction to this is people recognize how flexible they need to be in terms of their job situation, their living situation. That's going to make them be more likely to rent than own. And I think a lot of the recent increases in homeownership rates are just temporary, and we're likely to see homeownership rates decline again in the coming years for some of the financial and economic reasons that they're impacting us today, and also just the continued shift in societal preferences.
Thanks, Nate. Grant, any thoughts on that?
Well, I agree about the IRRs being improved. I mean, we target properties throughout the Southeast. These are large properties, so the expenses of managing a large 360, 500 unit property is virtually the same as 280 units. So we get the scale. We don't have people leaving the properties to go out and buy homes. That's not the hunt right now. The hunt right now is, hey, I just want to take care of my family, secure where I live, and I want to pay my bills, and I'm worried about my job. COVID actually reduced people in April and May from going out into the marketplace. Nobody could go out and shop. So we target 15%. We've delivered double that for 30 years now, over 33% real returns, appreciation, and cash flow. And I just think the story that Ernest talked about, home ownership, is just not the desirable product today. I think going forward, cap rates actually compress downward, not upward, because you can't get yield. The entire planet got whacked from yield. Disney doesn't yield now. General Motors won't yield. every place you could get yield in the past, Coca-Cola's at risk, the insurance, like every yield vehicle on this planet is now at risk. So an apartment deal that does 3, 4, 5, 6% in bad times is going to be more desirable in the future. And I believe people will pay more to have those assets that are very difficult to build. They take a long time, big permitting process, and that building will not take place at the same rate that it was taking place at.
Thank you. Appreciate that. So a question came in, and I'm going to throw this over to Chris, and it says, when do you expect to see a slight recovery on building? So essentially, increased building starts compared to pre-COVID era. And what are your thoughts on that, Chris? Are you seeing that in the market?
Yeah, I think new construction is obviously at a standstill right now, and I think it's probably going to be that way for a good 9 months to a year. When it starts back up, I think it's going to be a lower volume than what we've had in the past few years. So we're going to see a situation where the supply is somewhat stabilized, and the demand is going to be increasing. As many of the panelists mentioned, no one's buying a house. So, the dynamics there is very favorable.
Thank you.
Hey, Nick.
So,
Nick, this is
Yeah.
Ernest, or Grant, were you about to say
Ernest.
something? Go ahead.
Yeah, I was just going to say, look, I think if anything, you're going to see retail and office buildings converted to multifamily. I mean, there's two big risks here. One is blight. If blight starts showing up on the national landscape in cities across America with shopping centers, small retail outlets, and office buildings not being completed. I mean, I know a guy right now that spent millions of dollars getting 36 floors approved here in Florida. And now he's like, I don't want 36 floors. And by the way, I don't want office. I want to convert it back to multifamily. So he fought for years to try to get that approved. Now he wants to back out of it because it's a problem. And some of that office and retail, one, is going to be a risk to multifamily as a conversion possibility. And number two, our president, Mr. Donald Trump, this guy's a real estate guy. He's a restructure guy, and he hates the IRS. So I could see where they would pass something going forward benefiting new home purchases in the form of some kind of tax relief that could be a bit of a threat to apartments. But again, those things are down the road.
I agree with Grant. Those are great points. I think we're going to see some real creative avenues for solving the housing. I mean, there was a national housing crisis before this, and it didn't get any better. The numbers I was seeing for new development was ranging about 380,000 to 400 units to be delivered this year. And I've now seen that cut in half to 190 to 200. And keep in mind, 80 to 85% of those units were Class A properties where the rents are, $2,000 a month. That is not the market that we're working in, and that is not where most of the country is heading towards. So you're talking about, the 15 to 20% that was left, about 10% of that was in affordable housing, which is highly government subsidized. Very little new construction comes into our workforce sector. So I think what you're going to see is a lot of people living in these lifestyle Class A housing that were spending 40 and 45% of their budget for housing. They're now going to look at, the properties that Nate and Grant and Chris and I are owning and going, hey, these are really nice properties. And if I can cut my rent $400 to $500 a month and get out from underneath this credit card debt, or maybe save for this next crisis, that's what they're going to do. I think the slowdown in new construction is going to be significant because I think credit is going to be tougher to get. I think the pricing is going to go up. And I think there's just not going to be as many people willing to put that amount of money out when they can live in a great property like, the four of us own.
Thank you, Ernest. Nate, did you have anything to share in regard to those points that you'd like to jump in on before I move along?
No, I don't think so. I think certainly down the road, the conversion of kind of the shopping strip centers and where you used to have department stores anchoring strip centers, those are likely to go by the wayside, and they were demographically set up well for multifamily, so that could be a development opportunity down the road.
Thank you. Let's move along. So a question we have here is, what are investors think about? What are they buying? What are they selling? What are their strategies right now for multifamily investing? What are you seeing in the market? And I'll pass that over to Chris, please.
Yeah, I think most of our investors are on hold right now, and we're waiting to see when the market opens up. There's very little product on the market for sale, and so I think everybody's sort of holding off and sort of weathering the storm a little bit. And I think probably in this fall or late in the year, I think it will start opening up. We'll see more deals come on the market. But for right now, I think everybody's on the sidelines.
Thank you, Chris. Now, Chris, you're in Miami, right? And your investments are they regional per se? Are you seeing that in specific markets? And is anybody seeing that in alternative markets? A different view where they are seeing a significant amount of buying, folks taking advantage of the market cycle right now?
I don't think that's happening right now. I mean, it may happen later in the year, and I think that's what the smart money is doing. It's on the sideline waiting and sort of hoping that there's going to be some distress and some great opportunities later in the year. I think that's what everybody thinks.
This is Ernest. We're seeing some opportunities. I think investors have fallen into three buckets. I don't want to categorize them in any one. I think there's the investors that have just stopped. They've just pulled off. Maybe they're pulling some cash aside to get ready for some opportunity, and they're just sitting on the sideline right now. I think there's another group of investors that have a strategy. They've been through several of these ups and downs. They know not to buy too much into the high and not to get too scared of the lows. And they've got a plan and they're going to work it. And these are the guys that hit, the drive right down the fairway, and they're on the green and they're trying to two putt and maybe get a, subpar, a birdie or a par. And they're staying in the market. They're sticking with their plan. And then we've got the group, my investors are calling me and saying, how do we capitalize on the dislocation in this market? And, that's that third group. And so we are seeing some deals, granted 97% of the deals have been taken off the market, but all three of the deals that we had under contract when this thing started, we backed off of so we could watch their rents in April and May. One of those projects we're proceeding with to close at the end of this month. And we got a nice reduction in pricing. We completely rewrote the underwriting for the property to take into account, the possibility of reduced cash flow, higher, rent collection issues, just completely rewrite it, changed our underwriting standards. And we're going to move forward with that deal. And I think there's going to be, no matter where you are in the cycle, there's always sellers. There's always a buying opportunity. And so I think you just have to be really careful about how you approach it, how you underwrite it, and what you can learn. And again, we're long range investors. We believe in this, we believe in the long game in multifamily. And so we are seeing some opportunities.
Ernest, how big a discount did you get on that deal? How big a haircut?
We got off the pricing, we got a little over 5%, maybe closer to 6, I guess, actually. And then we got some discount in some terms. But what really helped us is our lender, we're with Freddie Mac, stepped up and gave us the same terms as they had before. So we didn't get caught up in the wider spread. Yeah. And we've got a sub-3 interest rate on that deal.
Wow. Yeah,
and I had to put a little more money in, but we would put in more money to get that low rate. And, this is a property that's next to one of the major medical centers in the United States. It's not in Houston. And it's occupied by, doctors, by interns, by nurses, by people at the medical school, by attorneys that wanted to be convenient to downtown. So it had this, there was no, leisure or hospitality or food services group in this rent roll. it was just a strong rent roll, and we jumped all over it. Grant, I'm glad you weren't aware of it. You'd have been competing with me, but it's a heck of a deal.
No, I'd have bought it. I wouldn't have competed. I'd have got it. So this is an interesting time, because the issue for me right now is I see so many guys waiting to get back into this game. It's not being held up by any competition other than the timing of a buyer, a seller, and a lender. The lenders are going to get back to this game because this is a safe bet for Fannie and Freddie. This play is so much safer than one single residence. They're going to load up on this product line as soon as this thing loosens up. The forbearance, they did not want to mention the forbearance word. They finally came out and said, okay, we'll talk about it. That is not being taken at the rate that everybody was so terrified in April of. And again, money has to move someplace. And where is it going to go? Where are the life insurance the pension funds with, hundreds of billions of dollars in cash, there's trillions of dollars sitting over at Blackstone. Where does this money go today? To startup? They have to deliver on cash flow, and they have investments that they've made that weren't good. If they were loaded up in office and retail and had multifamily, they will sell their multifamily toward the end of the year in order to cover their positions in the office and the retail, because they'll have to cover up their little mess at that public level. And that's where guys like us and our investors will benefit.
Thank you, Grant. So let me ask a follow-up question to that. Are assets going down in value? Are they holding tight? Where is the cash flow? I know obviously you mentioned that folks are holding on to cash, but there are some opportunities out there. So are assets holding tight? Where are they? And when I pass that over to Chris, and then feel free to jump in, gentlemen.
Yeah, look, I think just as Ernie mentioned, if there's any trades happening right now, it's going to be there's going to be some sort of discount. So whether it's 5% or 10% or whatever, there's definitely going to be a discount. It has to be, because the risk out there is how do you forecast what's the rent growth going to be, and how long is it going to take to get back to normal? So, you have to have a return for that. And the return is obviously in a lower price. Now, how much of a lower price makes sense? I don't know. And I think that's why, most of us are on the sideline waiting to get some idea of how this plays out, and can make hopefully good decisions.
Yeah, I have
Thank you.
kind of a nuanced view there. We've actually contracted on a couple property sales in the last few weeks at the same prices that we were offered pre-COVID. And so we've been able to demonstrate, sustained values for our assets, although I do think that, much of, the properties that are out there that were either, taken off the market before COVID or those that are coming on the market post will have, naturally have some sort of a discount attached to them, just simply because the overall underwriting approach that the marketplace is going to take is going to have to factor in some reductions in occupancy and collections just based on reality. But for those, individual properties that have been largely unaffected, we've been able to maintain our values.
Thank you. I appreciate that, Nate. So we had a question that came in. Let me throw this out to Ernest, please. So how do you see co-living developments as an investment, which is starting in California? And actually, Ernest, I'm not sure if this would be something from your perspective or just for the group itself. So the question that you see is co-living developments as an investment. And it's starting in California. Are you familiar with that? Are you seeing?
Yeah. Are you asking about co-living as a father of a single daughter, or are you asking about co-living as I don't, this, I worry about anything that starts in California. And I think you're seeing a lot. I think you're seeing co-living in the very expensive markets. I've seen it come up in Miami. I've certainly seen it all over New York and Boston, some other areas. I think there's a couple of answers to that. I think it's going to be on the fringe for a while, But certainly there is the safety and health issue concerned. It seems like younger people aren't as concerned about that. To me, it just goes back to this affordability crisis we have in the country, as it comes to housing. I think there's a safety issue that hasn't completely been addressed in co-living. I guess it goes under the, isn't it pretty to think so? But I think what I believe in terms of co-living is I think in some of the larger markets, what you're going to see are properties developed more like, college dorms or student housing, where you can go and rent just a room. You're just going to have some different kind of security on it. But, I don't know. I think there's a need for it because the cost of housing, especially for young people moving into some of the larger cities, is just off the charts. On the other hand, we've benefited from this high cost of living in these larger cities by having a number of people continue to come into the markets like Houston, where it is affordable to live and take advantage of that. So I know that was a wandering answer, and I apologize, but
It was, Ernest.
I just don't, I just don't see it being a across the U.S. type situation, but I can see it in the larger markets that are so expensive to live in.
Thanks, Ernest. Grant, did you want to jump in?
No, I was just joking with Ernest, but look, all
Thanks,
these
Frank.
ideas, all these, every time the institutions, not just California, but the institutions, when they sit around their boardrooms and decide, this year we're going urban, this year we're going, smaller, like almost every time they're wrong. And our suburban properties, we're suburban properties. We didn't stretch to buy them. We're bidding on assets that typically a Blackstone, a JP Morgan is bidding on. I need that buyer there because I know 6 years from now when I'm a seller, I'm not a seller in 2020. I bought these assets in the last 2 years. I'm not selling for 6 to 10 years. JP Morgan, Morgan Stanley, the institutions, the Blackstones are going to be there to buy them. So I'm either going to bid them up in a play, and most of that is good suburban 1,000 square foot properties, $1,500 a month rents. If they want to go pay another, too much for downtown, $360,000 a unit stuff that's not filled yet, that's not our place. So we're buying suburban, cash flow positive, 6% yields with 15% IRRs and properties that we expect over the next 6 to 8, 10 years can deliver actually 3x returns to our investors.
Thank you, Grant. I also want to throw out to the audience, I know we have well over 200 participants on this call. Please feel free to use the Q&A, send over whatever questions you may have. One additional question did just come in, and it says, have you seen any innovative or disruptive technology that you would consider incorporating into your buildings to alleviate various concerns? Let me throw that out, and I'll throw it out to Nate and see if you have any insight on that, and if anybody else would like to jump in.
I mean, there's a lot of technology, I think, that's associated with the virtual, renting, which obviously I think probably many of us on this call have been doing a lot of leasing without, physical tours and that sort of thing. That's not new technology, but I think it's being embraced both by landlords and prospective residents more than it was in the past. We've individually, as a firm been able, we were already set up to have all of our software and management and so forth integrated with our online platforms, and being able to accept payments electronically and being able to do work orders, through mobile apps and all of those sorts of things that have been in the market for a little bit while now, are definitely coming to the forefront more and more. And I think you'll continue to see that sort of evolution. It's not so much world-changing technology, but it's just people, repurposing their existing kind of familiarity and comfort with their phones and doing things on a more app-based, process.
Thanks, Nate. Let me also ask another question and follow up to that, to the group. So if you think about COVID and how everybody is being faced across not only the North America but the globe, have we incorporated or will you guys incorporate anything specific related to COVID in your buildings itself? Anything that comes to mind that you've taken an opportunity to be proactive with, and I'll throw that out to the group.
Yeah, I mean, we're following the protocols and procedures, and the arbitrary protocols and procedures, by the way, concocted by the government. Nobody knows what they're dealing with here. So the solution to all these issues is, and like the new technology question, here's some new technology. Be nice to the tenant. Say yes to the tenant. Treat the tenant like an owner that's paying $1 million or $10 million for a place. And you're going to have a building, if it's in the right location, around some kind of job support, where the marketplace wants to grow, where there's positive job migration, not negative like California, New York, New Jersey, where the government is friendly to the landlord and the owner, you're going to be fine in this asset class. There's no tricks to it because COVID is either it's everywhere or it's nowhere.
Yeah, this is Ernest. We're, I agree. We're taking all the necessary precautions and doing what we can. But, again, I think you take a step back because I agree with Grant. We're going to get through this. I'm a big believer that the herd mentality is what is going to get us through this more than anything else. But, I think whenever there's something, when life gives you lemons, try to make some lemonade if you can. So here's some things that we're seeing as relates, and I want to jump about the technology and the COVID-19. From the COVID-19, we certainly had more residents staying at home. We saw the parking lots filling up. They wanted to do things. So, we let them go to the pool. We had the gyms closed when we could. But some of the things that we saw is that people were so eager to interact. And, I think, again, like all my fellow panelists, we know that if we can build communities, there's a greater likelihood that our residents will renew, they'll stay there, and more importantly, they'll tell their friends about what a great place this is to live. And so we've seen people social distancing that never met each other, that are now walking their dogs at the same time and staying 6 feet apart and talking and building friendships. Or they go to get outside and go to the pool just to get it out in the sun and get a little warm weather. And they ask the person that's chair is 6 feet away, do you mind if I sit down, here? They're like, no, go ahead. And they start talking to each other. So we're seeing friendships emerge, from this situation where people didn't know their neighbors and now they do. And so we're simply going, hey, look, we've got to continue building this community by having events for the residents, maybe having cookouts instead of the mass following, come up and pick things up. But, I think, with a lot of the challenging situations that our country has faced in the past, I think we're underestimating the human spirit and what's going to get us through this. And we're seeing it in our small communities because people want to get through it. They want to help their neighbors. Here, I have an extra bottle of hand sanitizer. Take it. Here, I need this. Here, take that. And again, you build communities and these residents are going to stay with you because at the end of the day, this may be mine and Grant's and Nick's and Nate's apartment, but first and foremost, these are people's homes. And we've always been a big believer that returns to our investors start at our residents' front door. We know if we take care of our residents, then we'll take care of our investors. But if you turn that formula around where you try to extract every dime you can, not reinvest in the property, just flip these properties just to get money back to your investors, you won't survive very long. And so that's kind of what we're learning from this situation. And we're going to use that to nurture that going forward as well.
Thank you, Ernest. Some great points there. What I wanted to do was ask, and I'm going to send this over to Chris, and we have seen some really horrible effects for senior living, assisted living facilities, over the course of the last couple of months, and our hearts go out to those families. Maybe, Chris, you could talk a little bit about the effect on senior living. I know you're involved in that space, and can you talk a little bit about that, some changes and adjustments, and where do you see that all will transpire in the future?
Sure. Senior living is a very big category and everything gets lumped into senior living. all the way from skilled nursing and assisted, and then down to independent and age restricted. So it's a very broad category, and every segment of that category has been affected very differently. So the main things you're reading in the news media is the issues with the skilled nursing facilities. And what people need to realize is that, when folks go there, they're normally in really tough shape to begin with. Average length of stay in a nursing home is 8 months. And so, and a large number of them, are very susceptible to something like this. Even the normal flu causes a great number of deaths. So there's no question it's tragic what's happening, and it's certainly been a very, very difficult situation for the skilled nursing segment of the business. Our company's focused on the 55 and the independent living. And both of those categories have no medical whatsoever. And so, that part of the business is just like apartments in essence, and hasn't been affected. But most certainly the assisted living, the skilled nursing have been impacted. It's going to be a major, a major situation, and it'd be very interesting to see where values go after this occurrence.
Thank you, Chris. Appreciate it. So a question came in, and I'll propose this to Nate. Are you underwriting rent growth in 2021? And are you completing value add projects?
Sure. So, it's case by case, certainly, within our own portfolio, we've not been a group that does heavy value add historically. So, anything that we're doing on the value add spectrum is more moderate in nature, similar to some of the comments that Ernest made about, the affordability and keeping residents in their units and not taking every dollar off the table. We're more likely to scale value add over time and maintain higher occupancy and maybe a little bit less rent growth, but the trade-off being that there's less turnover and happier buildings, happier communities. So, the definitely non-essential CapEx was something that we put to the side early on in the response to this environment. I think that's starting to lessen up a little bit. Certainly when we're looking at new assets, we're considering rents that are going to either not grow in year one or have very, very small growth. I think many residents expect that they're not going to be paying higher rents just based on what's going on, and they do have some leverage to expect that given the environment. So we're looking at kind of a year of little to no growth when we're looking at new deals. We're looking at a slower ramp up of value add, again, perhaps even putting it on pause for year one and then starting in year two. And then, as it relates to occupancy and collections, definitely dialing those things back as well for probably a year, and working our way to a more stabilized place within, kind of 2 or 3 years. We'll see, again, each market and each asset is going to have different characteristics. If you see an asset that's been completely unaffected, it's going to be hard to bridge the bid and ask spread, between a buyer and a seller if the seller is sitting there saying, well, you're underwriting X, but there's no evidence that even makes sense. And so there's definitely going to be some back and forth and some price discovery. But net, we think we have to be a little bit more conservative in this time, in this time frame.
Thank you, Nate. So we had another couple of questions that just came in, and we have less than 10 minutes. So what I'd like to do is just kind of go through some of these quickly, and I'll propose it out to the group. So one came in from Julia. She says, can you speak more about how underwriting standards have changed? How much are you increasing the requirement for cap rate, IRR, et cetera, to account for COVID-19's risk?
This is Ernest. I'll take that. I'll kind of give you a general overview. And again, I think you have to look at it market by market, and you have to do a, understand, and I think I speak for all the panelists, we don't just look at the apartments. We look at the surrounding economic environment and what's driving the economy in that market. We always go back and look at the last few recessions to see how that market sustained and what happened then, and is that sustainable during this, a future downturn. But things we're doing different. Typically we've underwritten our apartments to 93 to 95% occupancy. We're now dropping that to 90 to 93%. We're certainly working in a higher rent loss. That is, people that wouldn't pay. We're increasing that by 100 to 300 basis points. Looking at a greater delinquency. We're maintaining a flat rent growth through 2021, and in some cases we actually might do a rent decrease. So we are trying to look at I won't call it a worst case, but just kind of an adjusted basis. So that's how we underwrite. But that doesn't mean that's how we're going to go out and perform in these markets that we think we can outperform. We're trying to buy at the best price we can and then beat those expectations every time. So we're looking at every aspect of that. We're also looking at what's the ability of delivery of new product into that market, what properties might come up for sale, and what could they do to renovate to change their rent. So we're just doing a deeper dive on the economy and a wider matrix of underwriting at each property.
Thank you, Ernest. Another question came in, and this is to the group also. It says, assuming all variables stay the same, including interest rates, where do you see the cap rate expanding, if at all, in what sector and to what degree? So I'll throw that out to the group.
Chris here. I don't see it expanding at all. In fact, I wouldn't be surprised if cap rates go down in the near future.
This is Ernest.
Again,
Go ahead, Grant.
Yeah. So, look, you can't just look at the cap rate thing.
Exactly.
The cap rate's based on 10 years ago. So those 10 years are gone. And we've never had treasury rates at 3/4 of a point. They're going to collapse. Those are not going to hold up. Worldwide, they have not held up. Apartments in America that are taken for granted by the investors in this country do not exist in other countries. You cannot go to London and find and put together a 1,000-unit portfolio. This is people, you go to Saudi Arabia and try to find this, or go to Dubai or Singapore. You cannot find these assets. You also will not find them at this rent. We complain in America about rents being too high. Go to Singapore, they're 80% higher. So we will have cap rate contraction on these type of assets in this country. Now, if I'm in Fargo, North Dakota, maybe not. If I'm in some parts of the Northeast or Midwest where maybe those automotive jobs don't exist in the future, if General Motors or Ford Motor Company fails, which they could, these are big job drivers. And if those jobs continue to move south, migrate out of California, migrate away from the high tax liberal states, New York, New Jersey, Illinois, if those jobs continue to migrate, if the Tesla moves out of Silicon Valley and says, you know what, I'm going to go set up shop in Austin, they're going to treat me right. Jobs will move there, apartments will be built there, cap rates will contract there in those parts of the country, and they maybe will expand in those dying parts of the migrating America that we are today.
I would underscore what Grant is saying. I agree completely, and I would also add that I think what we may be seeing in this post-COVID-19 environment, I think something that's really opened the eyes of all Americans, regardless of your political affiliation, is the number of critical jobs and supplies that we buy overseas that we don't control our supply chain. I think you are going to see a big movement of companies bringing those good jobs back into this country. And it's going to allow people to live in some good places. Again, they're not going to be the high paying jobs, but they're going to be good, solid workforce jobs, people making $45,000 to $85,000 a year. And I think those companies are not going to relocate into the high tax, hard to work areas. They're going to come south. They're going to come into good markets. Again, maybe I'm naive, but I just like to believe in the good of our country. I think we are going to see a resurgence post-COVID-19 because of the opening of our eyes and the reclaiming of our rights, not only as a technology and service leader in the world, but also as an industrial service leader in the world as well.
Wave that flag, Ernest.
Glad to, Grant.
Thank you, gentlemen, for the dialogue. I had a couple of quick questions, and we are just about at our time limit, but I wanted to throw a couple of these out at you just because I think they're really relevant. One question came in, and it's to all the panelists, and it said, would you be willing to receive rent payments through Bitcoin or looking to accept it in the near future? Some of the younger folks in the market are heading in this direction.
I receive Bitcoin in my other businesses now, and I would absolutely 100% be open to receiving it from my renters, including trying to figure out how to make my tenants, my residents, my renters, investors in the property.
Thank you, Grant. And then this, I think, came in for the group. It wasn't specified for anybody specific, so I'm going to throw it out to you. It'll be the last question. It says, which funds are fully covering distributions from cash flows? Do you expect to be able to continue to cover distributions fully? Does anybody want to take that on?
Well, if you're not covering them from cash flow, I think that's called a Ponzi scheme. I think there's let's not confuse pref and distributions, but yeah, all of our distributions that we're making are coming from cash flow. That's the only place they can come from. And they go up and down, but right now we're maintaining, pretty steady, and I expect that to continue.
And at Cardone Capital, we distribute every month. We did this beginning of April. We put them on a pause just to be sure this doesn't last longer than we thought. And we've been reserving those April, May. We're probably within a half a point to a point of what we would normally get last year, which is we are extremely thankful and grateful for. Look, any cash flow distributed, if you're above 4 or 5% a year, and you've got a great asset that over time is going to appreciate and provide the investors with tax credits and depreciation, that's a good thing.
Agree.
And our fund made full distribution for Q1 and will be in Q2 as well. Generally speaking, people are getting 6 to 8% annualized, and that's paid out on a quarterly basis.
Yeah, we don't do fund, and basically we've held all distributions currently.
Thank you very much, gentlemen. I think that was a really informative panel. I hope everybody in attendance enjoyed the discussion. I want to thank Ernest Johnson, Grant Cardone, Chris Finley, and Nate Klein for joining the panel and providing their insight today. You guys have a great afternoon, and I'm going to swing this back over to Michael and team. Michael, thank you very much.